One investment chart to rule them all. It's this simple. 14 decades of price inflation, which means the dollar declining in value. And what you can see here is going back to 1870, we had a dollar that was going up in value. That's what happens during a deflation. And so now we got the after the post-World War One, the World War One inflation, the post-World War One deflation, going all the way up to the Great Depression. And when the depressions or deflations happen, the dollar becomes to rise in value. And then there it is. FDR gets off the gold standard, and ever since then, down, 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 down. That's inflation, my friends. One chart to rule them all. And now the issue is your bonds. Your bonds are a guarantee loss of purchasing power because you will have a fixed income in an increasingly inflationary society. And when I say increasingly inflationary, that does not mean the inflation rate year over year is increasing more than the previous year, but it means every single year it gradually chips away at the purchasing power of the bond. A bond is fixed. It's issued at $1,000. It matures at $1,000. You can buy $1,000 worth of goods when it's issued. You can buy $700 worth of goods at maturity. Yes, you get 3% interest. That 3% interest on $1,000 is $30 a year. $30 a year will gradually buy you $29, $28, $27, $26, $25, and so on. Until at maturity, your $1,000 initial investment in the bond will buy you $700 worth of goods. Your $30 a year in interest will buy you $20 worth of goods. That is literally how bonds work. You are losing money. This is before taxes. You throw taxes in there and it's even worse. A bond cannot sustain your level of income for any period of time. It just can't, because the inflationary powers that be, the increasing cost of living because of the Federal Reserve inflating the currency every year, even though right now it's low, it doesn't matter. You can see the decline ever since we got off the gold standard rapidly. Now again, I'll show you the chart before that. Red is deflationary, blue is inflationary. So you got right here is the deflation of the Great Depression. The irony of it all is FDR gets off the gold standard in 1933, right after he took office, and yet is right there, 1935 and 36, when we had 25% unemployment. So inherently, just getting off the gold standard, inflating the currency, i.e. making it worth less, not worthless, but worth less each and every year, doesn't lead to mass employment, huge, prosperous times. It just doesn't. We can see that in right here, the Great Depression, man. Is FDR's policies that enhanced the Great Depression. There's just no getting around that. And it was not FDR's policies that got us out. It was FDR's policies that kept us in and made it worse. And here we got the Wilson World War I, which is he never should have gotten there, but Wilson wanted to get more government power, and he knew the way to do that was to enact wars, and thus he was able to take more of the economy, and we've been dealing with ever since. Here's the Great Depression, or the depressionary cycle after World War I, and what did Coolidge do? Nothing. So it came and went. Well, they came and went, without question. And the Roaring '20s were the recipient of that. Here's the Great Depression. Here it was under Hoover a little bit. FDR's horrible economic policies, kaboom, and it just enhanced it like you wouldn't believe. Here's World War II inflation. Because price controls always lead to inflation. Price controls do not hold the prices down. They always lead to inflation and scarcity, which is exactly what happened. And then Reagan and Volcker finally nipped that in the bud in the '82, and now we've seen a decline in the rise of inflation. But a decline in the rise of inflation doesn't mean a deflationary economy. It just means inflation is growing at a less rapid clip. And you can see the 10-year moving average is 1.6, but of course that doesn't include energy and housing. Is it right? Energy and housing, they don't include that in the CPI numbers. Let's see, I think is energy and housing. I can't remember. Food and energy, excuse me. They don't include food and energy in CPI numbers. That's what it is, food and energy. There it is, my friends. Bonds will not do the job. Just won't. You will have a rapidly declining or even a gradually declining loss in purchasing power. That's all there is to it. All there is to it. So don't get suckered into bonds. You have to have stocks. The only way to deal with a hedge against inflation is a growing asset that can grow with inflation. Bonds inherently cannot grow. They are a depreciating asset, not depreciating to the extent of a car, but they are a depreciating asset, and that they lose purchasing power guaranteed each and every year. Stocks, I mean, they could get killed. I mean, without question, you could lose all your money. But if earnings increase as inflation increases, and hopefully that'll go reflected in a dividend price increase, stocks are the only thing you have to deal with this right here. And you have to just keep that in mind. If you want to enhance your purchasing power, or at least keep it a level with an increasing cost of money, then you need stocks. No other way around that. All right, hope this helps. We'll see you.